Hello everyone, and welcome to episode 12 of my mini-series on CRT and ICT concepts. This episode is about key levels and integrating them with market profiles. I have already explained what market profiles are and their various intricacies, but now we'll go a step further by introducing key levels and PD arrays. We'll combine these with market profiles to deepen our understanding. First, I will explain each concept individually, then I'll show you how to integrate them and use them cohesively to generate trade ideas. Key levels refer to important price points, areas, or zones on the price chart where significant expansions or reversals occur. While this is a basic definition, it's the most accurate and easy to understand. Key levels have several characteristics. They can serve as zones where potential CRTs form or where expansion and reversal profiles occur. They can act as a catalyst or triggers for expansions and can also be used as confluence for trade ideas. For instance, if you identify a trade idea and a key level is involved, you may classify it as a high quality or A+ setup. Conversely, if no key level is involved, you can adjust your risk accordingly. In this way, key levels help you not only find high probability trade ideas, but also manage your risk. In fact, almost all of my entries are based on key levels, never in isolation. Finally, you can use key levels to frame trade ideas based on the factors that we've discussed. There are some key characteristics, and I wanted to introduce them, so prepare for what's ahead. Let's get started. This key level concept is going to bring a new life into your understanding and refine your grasp of market profiles even further. These key levels are known by multiple names. Some call them PD arrays, others even call them points of interest. I personally call them key levels. The name itself doesn't really matter. What matters is the theory and technical significance behind it. You can call it whatever you like, but for the sake of our understanding and efficiency, we will refer to them as key levels. This will make it easier to break down, explain, and relate to them. Let's discuss some important and relevant key levels. Some of the most important ones are the following. First, we have order blocks. This may be my favorite key level because order blocks have a rational logic behind their formation and use. They are one of the most objective key levels. There is a proper way to choose and select an order block, and in the hierarchy of key levels, from least significant to most significant, order blocks are the most significant and work the best when integrated with market profiles. Next, we have breaker blocks, another key level which is useful for framing trade ideas. Each of these key levels has their own logic and narrative, and I will discuss them in more detail later in the video. For now, consider this a brief introduction. Then we have FVGs, or fair value gaps. This is basically a lower timeframe turtle soup or a higher timeframe CRT. For efficiency, we will refer to it as an FVG. Finally, we have rejection blocks. This is an extreme form of an order block found at the extreme ends of an expansion swing or a range. When chosen correctly, it offers excellent trade ideas. We also do have highs and lows. If I had to choose only two key levels for trading, it would be order blocks and highs and lows. These are the two key levels that I use most often. I rarely use breaker blocks or FVGs. Most of my trade ideas revolve around order blocks or highs and lows. Go and take a look at my Twitter, and I do break down any trade that I take. Majority of the time I will be taking a turtle soup entry at the high or low, or entering off a Model 1 entry, which is our order block. Sometimes I will use inverse fair value gaps, but this is rare. There are other key levels like mitigation blocks, propulsion blocks, liquidity gaps, and opening gaps, but they mostly create noise and distraction. In my opinion, you do not need them. I don't use them myself. Stick to the key levels mentioned above. What you need to do are master these key levels. I've chosen these particular ones because they've worked for me and for my students, and they will work for you too. Adding more key levels just creates confusion, adding unnecessary variables. That's why I will focus on explaining only these important ones and the ones I personally use. Trading is mostly about having balance and an appropriate approach. If you lack knowledge, you will not succeed. However, if you do try to learn and use every single concept out there, it will create confusion and lead to analysis paralysis, where you won't be able to analyze the charts properly. This is why technical knowledge is only valuable when it's balanced and doesn't lean towards extremes. You could talk for hours about these topics, but that wouldn't help much, as explaining them in detail and being direct about it is the right approach. You can usually tell if someone truly knows what they're talking about just by listening to them. You can easily spot if someone's being serious or just trying to make a quick buck. This is why I do not charge for any of my content, but you see other gurus out there charging crazy amounts monthly. I will continue to bring all this information to you for free, so stay tuned. I've gathered knowledge from Romeo, Sham, ICT, the MMXM Trader, and many more. I've taken all the information and will refine it into one simple place. I've then added my own research, backtesting, and experience. That's exactly how you can succeed in trading. If you're just copying others without adding your own insights, it won't work out for you in the long run. However, remember that personalizing your approach is something to do after you've learned everything and thoroughly backtested and researched the concepts. For now, your focus should be on mastering the basics. Once you've gathered enough experience and intuition, you can begin to add your own touch. Everyone has their own way of looking at things, different mindsets, emotional and rational thinking, and perspectives. You need to do self-evaluation and choose the style that suits you best. Intraday trading highs and lows with order blocks and IFEGs at specific key times is what I've come to. You can come to your own conclusions. Now, let me explain what an order block is. The most refined definition that I could find is from Romeo, and it's the most accurate one. Here's the definition. The candle that dips above a high or below a low, when engulfed, is considered an order block. In this image, you can see a low here, and what happened is the price comes down to the target and takes out that low. For an order block to be valid, it must be formed after what is called a turtle soup. If there is no turtle soup, the order block isn't considered valid. Here, you can see the exact candle that purged below this low. Now, we wait for this candle to be engulfed. By engulfed, I mean that the price must close above it. Once the price closes above it, it becomes a valid order block. In this example, you can see that the price did form a big bulky candle and the price closed above the candle, which did form an order block. After this, we wait for the price to retest the order block, find support there, and then expand. This process is what we call an order block. Once the order block is tested, the price will expand and take out the opposing side of the range. This is our Model 1 entry. Now let's discuss breaker blocks. The definition of a breaker block is as follows. The high that takes out a low, or the low that takes out a high, when broken and retested, is known as a breaker block. In the hierarchy of key levels, breaker blocks sit in the mid-range of significance. but they can be important, especially on higher time frames. Here, you can see that we have this high and low, and what happened is that this high took out and turtle souped this low and then broke above it. After that, it became a breaker block. Now, we wait for the breaker block to be retested, find support there, and expect price to expand from that point. You can use the opposite approach to identify how a bearish breaker block or bearish order block looks. Now, let's talk about FVGs. One thing to remember is that if you understand what a turtle soup is, all these key levels will be easy for you to grasp. We've already discussed order blocks and breaker blocks, and you saw that the only reason that they were considered valid was due to the turtle soup that preceded them. When it comes to an FVG, it is essentially a lower time frame turtle soup. If you look at a higher time frame FVG on the lower time frame, it will basically appear as a lower time frame turtle soup. The definition of an FVG is a price gap between consecutive candles, which suggests an imbalance in the price action. But as I mentioned before, it's essentially a lower time frame turtle soup with a retracement profile. Now, let's move on to the most important key levels, which are highs and lows. Highs and lows are the most crucial key levels in the hierarchy, holding the top spot. If you look at the charts, you will see that most expansions and reversals occur around significant highs and lows. They are essentially the key points that drive the market. During a reversal, the price often targets a high before reversing immediately. Similarly, during an expansion, the price usually takes out a low or a high to grab liquidity before continuing its movement. Let's move on to another slide. Here we have a chart. On this chart, we're going to explain the anatomy of a price swing. This is ideally how the market moves. Now, it may not always look this clean or straightforward, but on an objective and mechanical level, these are the phases of a price swing. This is what we also refer to as the sequence, or TSQ. A price swing begins when the price takes out a significant low or high. In this case, we have a low here, and the price sweeps that low with this candle. Now, based on our definition of an order block, when such candle is engulfed, it becomes an order block. You can see that the price dipped below the low and then closed above the candle, and it has become a valid order block. After that, what happens is the price retests and expands from there. Similarly, when the price closes above the high that broke the low, it becomes a breaker block. Then the price retests the breaker block, finds support there, and expands, continuing towards the price swing. A price swing ends with what is called a turtle soup. So a price swing starts with a turtle soup and ends with one as well. Once the swing ends, another begins through the same mechanics and dynamics. This is essentially how the market moves and swings. While the appearance may vary, the core concept remains the same, as demonstrated here. Now, we have covered all of the key levels, and in next week's episode, we will cover how to combine these key levels with market profiles. Once you have watched next week's video, you will have all the tools to trade the market profitably. Don't worry, the mini-series is not over. After next week, the next topic is time. We will go over time and price theory and how to integrate it with CRT. So stay tuned and enjoy.